Hey guys, Foundational Monday, and we're going to talk about how it works when you want to put money into your business to start it, and then how you take money out. So this might be a little bit longer of a video, but I sat down today in a new client meeting with somebody, and a lot of the questions they asked were around the basics of how do you fund, in this example, an LLC, or how do you take money out? So I want to unpack a few things, give you some ideas around concept of contributing money to an LLC in this example, the default tax treatment of LLCs, and then how LLCs or pass-through entities, we'll kind of use those interchangeably, are taxed for purposes of taking the money out. All right, so let's start with a little bit of background. Everybody generally forms an LLC, a limited liability company. In the tax code, there is no LLC tax return. LLCs have default tax treatments. So let's start with that. An LLC with one member, a single member LLC, is by default a sole proprietorship. So if you've ever done consulting or gig work or like just been a freelancer, you're a sole proprietor. You're no different when you have an LLC with one owner that has not made an S Corp election. You're a disregarded entity, a sole proprietorship. Okay, so that's a default. If you have an LLC with multiple members, you can elect to be taxed as a corporation, like a C corporation, an S corporation, or a partnership. The S Corp and the partnership are flow-through entities. We won't talk about the C Corp for this. But by default, an LLC with multiple members is a tax partnership, but it can elect to be an S Corp. Okay, so that's a backdrop. We're going to think through LLCs, pass-through entities, putting money in, taking money out. Okay, when you go to form the company and you want to fund it with your money, there's no tax effect there. Like when you contribute money to an LLC that is a partnership, sole proprietorship, or S Corp, we'll just leave those there. There's no tax effect. The money is not taxable to the entity and you don't get a deduction for that. So that's step one. Second thing is you have to keep in mind how you got the funds to contribute. So if it's just idle cash sitting in your checking account and you use that to fund, again, your LLC, whether it's sole proprietorship, S Corp, or partnership, nothing's happened there. The tricky part comes in when you have to sell something. You have to liquidate a stock. You have to sell crypto. You have to sell an asset. Then you're going to determine if you have a gain or loss on that asset, and personally you'll pay taxes on it to then take that money and fund the LLC, right? So that's just a distinction. Even if you borrowed money and put the money in the LLC, like you borrowed money personally to fund the LLC, nothing's really happened there. So let's talk about what happens as you make money in a flow-through or pass-through entity. I'm going to use those terms interchangeably. So this throws people. In a flow-through or pass-through entity, you make money, or let me back up. You pay taxes on the money you make, not the money you take. And let me give you an example. There's caveats to this, but this is the general rule. And we're not going to talk about salary payments as an S Corp or guarantee payments as a partnership. We're going to talk about like profit distributions. Okay. So if your flow through entity makes $100,000, and let's just make this a very simple example and say, then you would have $100,000 on the last day of the year in your bank account. In that example, you would pay tax on the $100,000, whether you took the money out as a distribution and put it in your personal checking or not. Okay. That trips up a lot of people. They say, well, I haven't taken anything from it. And the tax code doesn't care. A pass-through entity pays the underlying owners, shareholders, partners, depending upon the type of entity, pay taxes on their share of a pass-through entity in their earnings, whether they've taken the money out or not. Let me give you a little follow-up to that example. Let's just say again, back to the original example. You made $100,000 in your, let's call it a partnership. The $100,000 is sitting in the checking account on December 31st. Let's call it 2026. For 2026, all the partners of that partnership are going to pay tax on their share of the $100,000. Let's assume on the first day of the next year, January 1st, 2027, the partners in the partnership go, we want to be done with this, distribute all the money, close up the business. At that point, when the 100 grand gets taken out and each owner gets their pro rata share of the 100, there is zero taxes. That's not taxable income. The income was taxed in the prior year when you made it, not when you took it, or make it when, pay taxes on money when you make it, not when you take it. For the most part, there's caveats to that. If you got debt involved, it changes things, but that's for the most part. Okay. So I want you to understand, like when you put money in generally, the act of contributing money is not taxable income nor deductible. And when you generally take money out, that's not a taxable transaction. Generally, there are caveats to that, specifically with S corps and as you borrow money. I'm not going to get into that, but a lot of people get tripped up on this and the language around putting money in. How do I do it? You can keep it really simple. Contribute money from your personal checking account, not deductible by you, not taxable to the recipient, which is your company. And then when you take money out in the form of distributions, that's different than when the company earned the money, which is that's when you'll recognize income and pay your taxes. So that's foundational money, how it works to put money in an LLC, whether that's a sole proprietorship, S corp, or partnership. Again, lots of caveats, lots of nuances, but giving you just some kind of high level concepts to think about when you put money in or take money out. So that's today's Monday, Foundational Monday. If you got a question or a comment, drop it below. I would love to answer your question on Mailbag Wednesday. Otherwise, we'll see you tomorrow on Tech Tool Tuesday. I think that's what it's called. Yeah, we'll see you tomorrow. All right, guys.